today's video, I'm going to go over a few common misconceptions about investment real estate and also a couple ways that we help our clients make the most of investment real estate as a part of their portfolio. Hi, my name is Derek Pesta, CEO and Certified Financial Planner at Pesta and Pesta Wealth Management. Our firm is located in Cupertino, California, and we tend to work with a lot of tech professionals in Silicon Valley. And when we work with our clients, a lot of them are looking for ways to diversify out of their employer stock or out of the stock market into another asset class, which most people are familiar with, real estate. And with real estate comes diversification, the ability to use leverage, and other tax benefits. And in today's video, I'm going to go over a few of the common misconceptions and also a couple examples of typically how we see our clients implementing real estate into their portfolio. So number one, probably the most common misconception is most clients that we work with have heard that real estate is a passive activity and that it's basically you just invest in it and you collect a check. While that is true in a dream scenario, most of the times the real estate that they're involved in involves them a lot more than they had hoped, even if they have a property management company, because what tends to happen is there are certain repairs or items that they'll let the property management company approve, but if it's a bigger ticket item, such as replacing a refrigerator or other things that maybe are over $1,000, they'll still have to approve those. Or if a tenant moves out, they'll still be ultimately responsible for approving the tenant in most situations. So those are one of the things that's kind of a misconception. Another thing that we tend to talk to clients about is the difference between passive activities and active activities. And so while a lot of people, when learning about real estate, they hear about the potential tax benefits from investing in real estate. And while most of these tax benefits are in the forms of passive losses, they don't really realize that, and they don't really understand that they can't take these passive losses and offset these against their ordinary income from RSUs vesting or W-2 wage income. So this is another misconception. And then the third is really the ability to use leverage. And so a lot of clients, when looking at investing into real estate, they're thinking about buying stocks and bonds, and usually you do that, you have to put the whole amount up front to buy. With real estate, really what comes into play is, yes, you can pay cash for properties, and that helps, reduce stress and not have to worry about debt. But one of the benefits of real estate is that you could potentially use leverage to not have to put as much money down, thus increasing your ability to make the most use out of a real estate as an investment. So now we've talked about a couple of the misconceptions, I want to walk you through a case study on how we kind of help guide our clients through this decision. So first, usually what we'll see with a client is that they're currently living in their home, and it's usually their starter home, but now that their income is moving up, they have some more RSUs that have vested, and their net worth has increased substantially. They usually want to move into a nicer area, usually want to move into an area that has a better school district, or they just want to move into a bigger, nicer home because their family has grown in size. And so what tends up happening is, or what usually happens is, they want to hang on to their existing primary residence and then put a down payment on a new place and move into that new home, and then rent out their existing place. And I usually think this is a good idea. Number one, at least here in Silicon Valley, it doesn't seem like they're building many single-family style homes anymore. Most of the new construction that I see going up is all townhomes. It's a bunch of condos. It's a lot of dense multifamily housing. And so if there's going to be a continuing demand for single-family homes in Silicon Valley because of this, then that increasing demand with ever decreasing supply, or at least stagnant supply of single-family homes, in my opinion, would make investing in single-family homes pretty attractive. Second, the ability for you to grow your net worth in real estate so that that property is appreciated in value without you having to realize the gain is also attractive. So for example, let's say this client, has a single family home, maybe it's worth $1.5 million, and it's growing at 7% per year, just an average number based on the trends we're seeing here in Silicon Valley. Well, the cool thing about that is that because they are not selling the property and they're just hanging on to it, that property is growing in value, and that gain is growing, because it's unrealized and they're not having to pay taxes on it. And so what we usually recommend is, if they want to invest more into real estate, is looking for single family homes within Silicon Valley, next or near headquarters of tech companies, and in areas that have good school districts. And these tend to be properties that appreciate the highest for a good reason. And the reason why we don't necessarily look for properties that generate a lot of cash flow is because these clients are already in high income tax brackets, and even if the depreciation from the property doesn't shield them from all of the rental income, they don't need more income, they don't need higher cash flow. And so by having a property in Silicon Valley where maybe the cap rate, which is just the net operating income divided by the current market value, even if that's only like 3 or 4%, that's okay, because we know that we're getting maybe a 7% growth rate on the property itself. And then what clients like to do is, once they do end up retiring, then they're looking for cash flow. Then they're looking for a more stable form of income coming in monthly to replace their paycheck. And so this is where we usually recommend 2 routes, or 3 actually. The first is, they could just continue to hold on to that property, continue to collect the rent, but again, the cash flow, the yield on that property is going to be kind of low, maybe 3%, 4%. And if they have a property management company, they're probably still going to be involved to some level of degree. The second option that they could look at is looking to diversify out of state into areas like Cincinnati, Ohio, where the cap rates or the cash flow is higher, because the investment properties there are, they're not as high in value, but the rental income that they can demand are still relatively high. So instead of getting a cap rate of like 3 or 4%, you might be getting a cap rate closer to 8 or 12%, which is pretty common for those areas. And the reason why we like those areas, not only are the cap rates high, but you have good employers in those areas. Employers like Kroger, Procter & Gamble, even the Children's Hospital. And so those tenants will probably be good tenants with good paying jobs to be able to continue to pay that rent. So that's the second option. Looking at doing a 1031 exchange so you don't have to pay taxes on the gain, and finding a like property and doing that in maybe 1 or several properties for higher cash flow or higher monthly income. The third option that we work with clients is a company that we partner with called RCX, and this is truly a hands-off approach, which a lot of clients like in retirement. With this approach, it allows you to do a 1031 exchange of your rental property, which in this example might be a single family home, but instead of just having one single family home that's giving you a relatively low cap rate of 3 or 4%, you would be able, in this instance, to look at the available deals during that month and see what's on the market, and you might be able to diversify that single family home into multiple different types of real estate holdings. So think about commercial properties such as manufacturing warehouses like Amazon warehouses and distribution centers. Think student housing at universities. Think about senior homes, senior housing. You can even think about things like multifamily apartments that you just wouldn't have access to unless you're an institutional level investor. Or think about single family homes, but they get pooled together and then they rent these out as well. So not only does it kind of diversify your risk in terms of your asset class within real estate, so you would have commercial, residential, but you could also diversify in terms of geography. So maybe you diversify your risk so that you're diversified in different areas, so that if one area of the country is going through a slump or a recession, maybe your other properties in other areas are doing just fine and maybe even thriving, and you diversify your geography risk. And the benefit of this is that it's truly hands-off. RCX is managing those properties. You're still getting your cap rate that's similar, maybe 4%. You're getting that check every month, so it's a stable form of income. And then at the end of the holding period, which is typically around 7 years, you can choose to continue to roll your investment into new opportunities that RCX has, or you could look at doing a 1031 exchange out and do something like the Cincinnati, Ohio example, where you're managing those properties yourself if you wanted to go that route. And if you're doing that, you could look at applying for the real estate professional status and taking those losses and making those active. So that's something that you might want to talk to us about and plan with your CPA so that we can help you be more efficient. So all in all, these are a couple different strategies. Again, number one is keeping those single family homes as rental properties in Silicon Valley. It's a great strategy. But if you're looking in retirement for a higher income and a higher cash flow that's pretty steady, the second option would be to look at other areas of the United States like Cincinnati, Ohio, that have higher cap rates, higher cash flow. And then the third option would be to take a really hands-off approach to increase your diversification into multiple properties and use a company that we partner with, like RCX, to give you that diversification, to give you that institutional level access to investment properties, and to be able to continue to leverage the 1031 exchange and continue to defer that gain. And ultimately what you would do is just continue to defer that gain until you and your spouse pass away. And then when you pass away, your properties would get a full step up in basis, and then your heirs would inherit those, and potentially if they wanted to hang on to them, they could, or if they wanted to sell them and liquidate them, the next day or the next month, they'd have basically no tax gain, assuming those properties didn't gain anything from when you passed away, and you'd be in a great position. So if you'd like to schedule a consultation with our team, please click the Calendly link below, and we'd be happy to go into a little bit more detail on how these strategies may or may not pertain to your unique situation. So we look forward to hearing from you. If you have any questions, comments, or suggestions, please put them below in the comments, and we look forward to meeting with you soon. Thank you so much, and have a great day.